Good evening, everybody. Welcome to Zoom at 8. My name is Julie Anne Peterson, and I am your host every Tuesday night. As well, I am a loan officer, senior director at Old Capital Lending, and we are a premier provider of debt. And what does that mean to you? All it means is that I can find you the right lending tool, vehicle, for your asset that you're trying to figure out. Now, we'll do other assets other than multifamily, but we really are specialists in multifamily. So I want to be your lender of choice. So we're going to look for your T12 rent roll, offering memorandum, and your underwriting. Send it over. But send it over to me after you call the insurance broker, JT Lynch, and after you call the taxing authority and calling a property manager. Once you've done all that and your number for returns, I don't care about your returns unless I am an investor on the deal, and then I very much want to know what the returns are. But all I care about is that my banks are going to get paid. Are we surviving to 25? Because it has been a tough year, 2023. Those people that were the class of 21 and 22, they got into some deals and they're struggling. They may need to be revived to 25, and then they can thrive potentially in 25. So today we're going to talk about Old Capital, quick market update, some financing options, some Q&A. So let's see how we can help you. So a little bit about me. Some of you are brand new and you don't know who the heck you're showing up for. So I've been doing real estate for 33 years, actually. Some people think I look like Edna Mode. She told us nobody can wear a cape. No capes, right? But listen, I tried to wear the cape for 15 of those 33 years. And it wasn't until these lenders said, just go away. Because I said I could do this on my own. And when I finally took the cape off and I let other people help me is when I had success. And I ended up selling I had up to 20 unit building, and I had single family, and I had smaller assets, some 5-unit buildings, 10-unit buildings. So I sold them. I had them all in California. You know what that's like, right? I sold them, got into limited partnerships in multifamily, and now I'm also not only a mortgage broker, but I'm also an investor. I also capital raise. So I'm a little different than most of the brokers out there. I can help in so many ways. Old Capital, we typically close about 1.2 billion a year, and we started in Texas, and now we are nationwide. As I mentioned, we do all asset classes. 93% of our business is in multifamily, but we can help on those mobile home parks, the storage, student housing. I'm doing a big deal right now. Any of these, we can provide lending. We also provide education. Really check out the Old Capital podcast. There is an amazing one that they just dropped, and it is about what's happening currently and trying to get out of deals right now. We also do the Old Capital Conference. This is typically September, October. It is an amazing group of people that show up. You can find your next partner. You can find your next broker. You can find your next deal there. So let's get into the quick market update. We see a massive pipeline of ground up construction being delivered in this next year. Take a look. 536,000 units are coming, and they're coming to a market near you. We've got Austin, we've got Dallas, we've got Miami, St. Petersburg. Man, oh man, I was there last week. Just cranes everywhere. The growth still is exceeding in some of these markets. But what we're seeing is some of the vacancies are starting to come up because the absorption. So take a look here. Vacancy rate is in 2024, we're seeing it 6%, continues to go up. So where should we be buying? Where do we see less ground up construction? Take a look. Let's all go to the Midwest. Let's have coffee there, because this is the market. You can see the inventory that's coming on board is 1.5 in the Midwest, and the rent growth continues at 2.7. So this is the strongest market. If you look in the southern states, we've had inventory of 3% increase, and the rent growth has gone down 1.3%. The mountain states, 4% growth. My goodness. And rent growth has gone down 0.5%. So I highly recommend taking a look at these Midwestern states. They are really strong right now. Get there soon, otherwise you're going to be late. So what other things should you be considering? The NOI growth. I think this is huge. Here's the forecast. Not a huge increase in the forecast for NOI. You're really going to need to dig deep on the expenses as well as other income. Renewal rates too. We want to try and keep people in your units. We are doing everything possible to not get people to move out, because why? We are going to have to renovate those units. Be thinking about putting in LOIs. How many need to be renovated? How long have people stayed? Can you renew them at the higher rates? So what else are we looking at? We're looking at the 10-year Treasury. It has been all over the place this last year. We saw a 1%, basically a 1% drop. 10-year Treasury is based on investor sentiment. If you look at the SOFR, which is your short-term Fed funds, we expect those to be going down. But when the more people are showing up for work, this is getting extended. We're not going to probably see it in March. People thought we were going to see it in March, in May, June. I think our first decline will probably be in June. So let's look at loan maturities. That's another area that's going to be hitting significantly in multifamily. Take a look at this year. More maturities. Why? That is going to be your bridge lending. We saw a lot of people take bridge out in 2021, and a lot of people thought, the rates would go down, inflation would be going down. That's where we're seeing these distressed assets coming on board. Okay, but we also do know that a lot of the lenders are starting to work with people. So what do I know? My crystal ball, I bought it at Walmart. It's broken. I don't know what's going on, but I do know that rent growth will go up 2.5% is what we're hearing, 2.5% rent growth. So if you're underwriting deals, and again, it's going to depend on the market that you're in, but overall 2.5 vacancy rate is increasing, 5.7. So some are going to be more, some are going to be less. This year, our volume is down about 50%. We saw a huge difference in sales volume. So the projection 285, we see 370 to 380 this year. So again, we're seeing deal flow. So top performers, we want to be looking at rent growth. We want to be looking at occupancy. We want to look at supply and demand. All of these are hitting these markers. Equity is a problem across the nation in many deals. Now, there is institutional equity. There's a lot of capital sitting on the sidelines. But again, that bid ask, how much is it worth and how much am I going to buy it for, is still a challenge, because they're trying to figure out what's the next step. And so you'll see a lot of deals on the market, but that doesn't necessarily mean they're going to sell. So let's talk about financing. So these are the products today that are working. Agency, so your Fannie and Freddie, those are your non-recourse loans. Assumptions can be a possibility. Bank debt, you got to be in the market, and bridge loans. Okay. So agency financing, this is the gold standard. Do you qualify? Do you even know if you qualify? There's 4 requirements. One is 90% occupied for 90 days. You can underwrite it if 85 to 90% occupied for 1 month. It takes us 60 days to close these deals. All right. It's going to take you a month to secure it with your PSA, your LOI, your PSA. So it's really a 90-day process. So second one is your net worth is greater than the loan amount. Can be equal to, but I like greater than. So you need to make sure you have money in the bank. People say, oh, use other people's money. Well, potentially. I heard today that people are looking for deals, finding a deal, and bringing it to a sponsor. Some of those sponsors do not want to put any money into the deal. They'll sponsor, but they're not putting money in. So you need to make sure your partners are all aligned so you can get a deal done. All right. Liquidity, 10% of the loan amount in cash sitting in a bank. And then in multifamily, I'm going to need one transaction held for 2 years. Okay. That's on the Fannie side. On the Freddie side, I need 3 to 5 transactions held for 2 years. And then the last piece is a guideline. It's not written, but this is how we see things, okay? The money that you're going to bring into the deal, that's called a capital raise, or it's equity in, or it's a down payment, okay? Those are all equal the same, okay? But I need 10%, 5 to 10% of that down payment, of that equity brought in. It needs to come from your general partnership. So if you're signing on the loan, you are going to need, or your general partnership needs to bring in 5 to 10%. Let's go through a deal. You got $10 million deal. I'm going to bring 70% of that. So I'm giving you a loan for $7 million. Okay, you're paying 10, I'm bringing 7. You're going to bring in 30%, which is 3 million. Okay. I need from the general partnership, I need 7 million in net worth. That can come from one person, it can come from 3 or 4. But keep in mind, not everybody plays well together. So the least amount of people you can put on your team, the better. If you can find one person that's going to be your asset manager, you have one person that's your sponsor, and you have one person that is underwriting it and helping capital raise, that's excellent. Our post-close liquidity, that's the 10%, needs to be sitting in a bank until we close. I need 700,000. Okay, sitting in a bank. Now that's marketable securities as well. Well, what are marketable securities? Not your 401k and IRA, but your stocks and bonds. If they should have a cash value, or your life insurance policy. Not the 1 million or the 10 million that I took out of my husband, but the cash value. It might be only worth $50. That is a marketable security. That can be used for post-close liquidity. So I need 700,000. Experience, we talked about your 2 years, one deal on Fannie, or 3 to 5, 2 years on Freddie. And then that equity piece, I need 150 to 300,000 coming from the general partnership. So that's the breakdown. So really what I need is about 10% of the purchase price in cash. So be thinking about that. Where is it coming from? Who is it? How is the sponsor? Do they have net worth? Do they have the experience? Signing on a loan with Fannie and Freddie or a bank will get you there. We just need to know how long you've been doing this. Agency financing, real quick, 5, 7, 10, 12-year loans. Okay. These can get up to 75 or 80, but today underwrite them at 65 or 70. Debt service, I would underwrite at 125 in most markets. We're in a smaller tertiary market, you're going to be 130, 135 to 140, just depends. These are 30-year amortizing loans. Typically, you'll get 1 to 5 years of interest only, as much as 10. So like full term IO, amazing. You'll pay 1% origination, whether I do it or the bank does it direct. What you will need to know is what kind of step down prepayment, or if you're going to go with the yield maintenance. We're not going to go over that today. We'll talk about that another time. These are the assumptions that we're seeing. They're out there. They can be good, But what you want is something that has 5 or more years left on it. Okay. So you want to be careful on assumptions. 3.75 or more for 3 years left is not a deal. Okay. 3.75 and 5 or 8 years left is a deal. You want to make sure that you're not over the cap rate. If it's 50 basis points over the cap rate, I'm okay with that, but not anymore. Again, you don't want to go into negative leverage. And if we have a shorter term loan, 4 years left, you want to be underwriting it to that 5th year, and you want to cost average. Today I'm at 650, and this is at 375. You're going to, use the average of those and make sure that it still works. And you still have to qualify, still have to have the net worth, the liquidity experience on board. All right, bank financing, lots of options there, but it's recourse lending. So you're signing on the loan and they're coming after you if you default. Each person is 100% liable for that default. So typically you're going to see 5-year loans, 25-year AM as opposed to 30. Will give you 1 to 2 years of interest only. You are probably going to bring in 2 to 5 and maybe even 2 to 5% in deposits. A bank wants to have a relationship with you and a deposit relationship with you. So you may need to bring in 100, 250, 500,000. Creditors will come in and see that the bank is doing business with their investors, with their depositors. I think that there's still a place for bridge, but I say it's fixed. You're going to be underwriting these at, right now it's 1075 to 1150. I can also do some at 875, 950. These are shorter term loans, 2 to 3 years, interest only. Can potentially extend and extend again. 30-year amortization. This is a non-recourse loan. So yes, you're signing, but not your life away. And I will go down to 500,000 on this. Now, you're going to pay 1% to get in the origination fee and 1% to exit. However, if you want to go to an agency loan, you can start out with a 1.25 with 0 exit, and then going into an agency that would cost you another 1%. Now, if we're going to be doing this for you, we do charge a 1% broker fee. Happy to walk you through that if it makes sense. Not going to spend any time on adjustable bridge. These are expensive. Again, it's a 2 to 3 year loan, but you are required to have a rate cap. So on a $20 million deal, you have to buy a rate cap for $1.1 million, 1.189. And this is the challenge in today's market. People have to belly up to the bar when they're not making any money and they have to buy a new rate cap. And that's what's tanking these deals. So that's why you're seeing a lot of deals come on the market. So there's other types of financing that we can walk you through. HUD financing. That's a longer term, that's 35 years. Fannie and Freddie floaters, maybe, again, you're going to have a rate cap, seller finance, pref equity, hard money, gap funding. Remember, help me, help you, okay? You help me by giving me the address, how many units, year was it built, what is the business plan? I'm going to hold this for 5 years. I'm going to need 5-year financing. I'm going to need 7-year financing, but I'm exiting in 5 years. What kind of renovations? Where are you located? Well, I'm located in Kansas City and I'm buying in Miami. Okay. If I'm going to a bank lending, that's not going to be very easy. We need to know who's got boots on the ground. So these are all the questions that I would like to know when you're sending me the deal. How long have you been in real estate? How many assets do you own? Single family, multifamily? Have you spoken with a property manager? Have they vetted the deal? Have you sent it to insurance? Okay. This is great information. But more importantly, are you prepared? Get your personal financial statement and your schedule of real estate in order. You need to know how much you're worth. Because when I ask you, do you qualify? If you're going for a $20 million deal, and I'm bringing 15 million. I need $15 million in net worth. If you're only worth 1 million, who's going to make up that difference? Educate yourself on how much you're worth and look for the right partners. Super important. And to get a quote, we're going to go with a T12, a rent roll, an offering memorandum, if there is one. If it's off market, then no. And underwriting, your underwriting model. So get to know me. That's why you come here. You get to know me. You get to know other people in the room. So jump on a call with me. Let's do this. Let's get to know each other. Send me this information before you put in an LOI. Super critical. You do not want to overpay. Okay. Send me all that. We'll underwrite it, and I'll give you information on what the lender's going to bring in 48 hours. Just give me an opportunity. It's super important. Make that commitment to yourself. Here's my contact information. If you don't have it, take a picture. I'm on all the social medias. You'll find me. So connect with me there. Any questions in the house? Who else?
I have a question, Julie.
Yes.
When taking over an assumable loan, how long does that process take?
Well, it should take 60 days, but it can take 90, depending on how busy the lender is.
And it just depends upon who owns the loan to
Correct.
determine what kind of how picky they are, maybe about the sponsorship team. It's there, so they have to approve whoever's coming in. Is that something that's a little bit more of a qualification? Do you need to be above the qualifications that you're talking here for just a regular loan for assumables, or
Still going to be, yeah, you're still going to need to qualify. Same thing. We will help with assumptions. Now, typically it's a 1% to assume, to get these loans. We charge a half when there's an assumption. But as a new investor coming into an assumption, it's a brand new loan for you. You've never done this. So we can help you get your paperwork in order. And at the end of the day, that lender has the deal. They own it. So they want to make sure that you're as qualified, if not more, than the current owner, right, who's selling it to you as the buyer.